Okay, so welcome to everybody who's joining us today. So this is going to be a webinar delivered by Percival and Miller, and we're going to be talking to you about contractor insolvency risk in the context of development agreement negotiations. So we should be with you for about 45 minutes today. We're hoping to be wrapped up by 3 o'clock. We're going to allow time for questions at the end of the session. If you look towards the bottom of your screen, you'll see that there is a box there for a Q&A. So if anybody has a question that they want to raise at any time during the speakers' presentations, they can put it into that box. And then when we get to the Q&A session, we'll do our best to work through as many of those as possible. If anybody has any technical issues, you can use the chat box as well. If there's any problems with audio or visual, please do put a message in the chat box and a member of our team will try to assist you. Okay, so just to give you a bit of an introduction as to our speakers that we've got today and the topics we're going to be talking about. So I'm Nicola Curl. I'm a partner in the commercial property department, specialising in development. So out for a range of landowners, house builders and commercial developers. And I'll talk to you briefly today just around the legal structure of development agreements and some of the protections that are already built into those documents in favour of the employer if there is a breach by the developer, including insolvency events. We've got Simon Franklin, who's director and is a specialist in construction law. So he's just going to give you a bit of perspective as to what is happening in the construction sector at the moment and the heightened insolvency risk. We've got Estelle Corner, who's a partner also in commercial property, specialising in social housing, and she'll give you a perspective from particularly registered provider development agreements and the employer's perspective there as to how they want contractor insolvency risk to be dealt with in those types of transactions. So just on to the next slide, we've got joining us from Miller. We have got Jason Baston, and Jason is a construction risks solution expert, and he's going to be giving you some insights today on insolvency risk mitigation measures. And we have Callum Griffiths, who's a surety specialist broker, and he'll be talking to you about some of the extra security that employers might want to look for when they're putting out their tendering packages for works. Okay, so to begin with, I'm going to hand you over to Simon, who's going to talk to you about what's currently happening in the sector. Thank you.
Thank you, Nicola. Good morning, good afternoon, sorry, everybody. It's one of those days, it's disappearing quicker than I thought. Yeah, so obviously the construction sector, there's a number of insolvencies been on the rise recently, you know, both high profile insult companies such as Carillion a few years ago, and, you know, lots of other smaller companies, not just necessarily the big contractors, but smaller companies down the supply chain, and anyone involved in the construction sector really seem to be hit by this. And it's sort of it's a bit of a barometer really. I know economists use the construction industry as a guide to how they're doing generally, and the reason I think why the construction industry is particularly vulnerable to insolvencies, I'll come to in a second, but just to give you a bit of background. So, you know, the Insolvency Service provided some data up until April this year, and it shows the figures on the screen there. So in February 2022, there were 307 construction sector companies going into insolvency. That rose to 419 in March, and then a slight dip back in April, but only down to 384. And if you compare that to this time last year, it was about 157 in April. So you can see that, you know, it's been high, but actually in the last year or so, it's doubled. And the industry guidance and advice is suggesting that these high level of insolvency, we're going to be seeing this for the next 9 months, rest of this year and into 2023. So we can have the next slide, please. So what is this? So as I said, the reason, you know, the construction industry is particularly vulnerable to insolvencies, and I think there's perhaps two factors at play here. One is just the inherent risks of the industry. You know, there is high levels of competition within construction, and that generally leads to, you know, firms bidding low in order to secure projects and secure work and get a pipeline of work. You know, in my experience, you know, I've certainly come more than once when a contractor has bid below cost just in order to get the job on the books. And that's been the case for a while and long I can remember. And the construction industry operates on tight margins, so bidding low and getting a good book of work is seen as one tactic, but obviously you are exposed to insolvency and to cash flow issues. And also just the next factor is just the way that the construction industry, payment in the construction industry generally works. It's inevitably payment in arrears. You will do the work and then, ideally you should be paid within 30 days, but, I think anyone involved in the construction sector knows that doesn't necessarily happen. And even if the contractual period is 30 days, doesn't mean payment will flow through. Quite often those payment terms are pushed out to 45, 90, 120 days. So, you've got a low margin, you've bid low to get the work, and then you're taking the cash flow risk over an enormous period of time until you get payment. Linked with that is still the industry, quite wide use in the industry of retentions, cash retentions. So with a percentage of each interim payment is withheld until either the completion of the works or the end of the defects liability period. It could be 3%, 5%, but I've seen up to 10, 15, 20% retentions, and obviously that has a massive impact on cash flow, meaning that you're being squeezed even further. And just the supply chain, in any construction project, there will be at least 2, 3, possibly 4 or 5 layers of contractors and subcontractors involved in the project. So obviously any insolvency or any issues in terms of cash flow or financing at any part of that supply chain can have a massive effect up and down. So obviously a large contractor going bust is going to affect many smaller subcontractors, but equally if you've got a smaller subcontractor on a project that goes bust and that causes you a delay, as a main contractor, you're then taking the risk under your contract for those delays. So those risks have been in the industry for a long time. And I think if we can have the next slide, please. I think what we've seen in the last couple of years has compounded those inherent risks to create almost a perfect storm. So as a result of the combined effect of Brexit and COVID in the last couple of years, material costs have gone through the roof, and there's a shortage of the materials because we can't get them in the country because of Brexit and COVID. So companies that were already pricing low on jobs have seen their costs double, treble in some instances. Linked to that is, if you've got a contract that was signed, a couple of years ago, chances are that certainly if it's a JCT contract, the fluctuation provisions, which are the provisions that allow you to adjust the contract price to take effective or to take into account changes in materials and labour, will have been deleted. It will simply be, as a lawyer, normally it's the first thing you struck out of a contract, fluctuation provisions. So that, with the rising cost of materials, means you're hampered even more than you would have been. In terms of, we've got the delayed investment decisions. That although construction work was permitted to carry on through the course of lockdown and through COVID, a lot of investment companies, a lot of funders were not necessarily okay in greenlighting investments in these developments until they knew what the market conditions would be, or until they themselves had come through the effects of COVID. So, again, a contractor may think he has a good pipeline of work sitting there ready to go, but if the button doesn't get pressed, then you're just incurring overheads and costs, and you're not getting that cash in when you thought you were. And from a legal perspective, there's the contractual consequences of COVID. This obviously was unforeseen. Contracts, when they were written, the last JCT in 2016 didn't have any idea that such a pandemic event would happen or potentially be a risk. So a lot of contractors who entered into contracts 2 years ago have got no contractual entitlement to claim costs in the event of the pandemic. So all of these compounding effects, combined with the inherent risks that contractors and construction companies are taking on, I think, as I said, it just created this perfect storm. and we're just seeing this huge rise in insolvencies. I think that's a bit of a background. Obviously, there's more detail you can drill down into that, but I think that gives an overview of why we are seeing the situation we're in now. So on that, I'd now like to hand you back to Nicola to give you a bit more of a detailed insight from the development perspective.
Thanks, Simon. So yeah, just to recap really on the general structure of a development agreement and some of the existing protections that are built into that that offer some comfort to the employer. So you'll have a works package, and that will generally be incorporated by reference to an agreed set of specifications of works. And then those works are to be carried out in accordance with an agreed programme and timings. There'll then be linked stage payments as and when practical completion of each stage of works is achieved. But then against those payments, as Simon touched on previously, there's generally a retention, normally around the region of 10%, that's held back by the employer. And that's intended to mitigate its losses if there is a developer breach that occurs. So there'll be a target date generally for completion of the works, but the developer is entitled to reasonable extensions. And that could be a COVID delay clause or to do with supply of labour or materials. But then ultimately there'll be a long stop date. And if works aren't delivered by that long stop date, then the employer will have further entitlements. And that may be payments of damages in the form of LADs for delays to works. Obviously, that's not going to be of any reassurance to the employer if we've got an insolvency event, because as an unsecured creditor, it's not likely that there'll be anyone around to pay those LADs. So they'll be looking to step into the shoes of the developer. They'll be looking to exercise their right to terminate the development agreement and then take on the works. So the question is, with the retention that's been held back, is that of sufficient comfort to the employer and to enable them to proceed to finish off the development? So I'll hand over to Estelle now, who will give you a bit of perspective from the employer when they're seeking to negotiate these development agreements.
Hi, yes, thanks, Nicola. I'm just going to add a bit of perspective from a housing association or other RP, registered provider of social housing, who's building out social housing. There are two kind of schemes they'd be involved in. Where RPs are doing their own schemes, they're really in much the same position as any other employer that Nicola spoke about just now. But the other scenario is Section 106 schemes, and this is where we tend to find a lot of tension. And in fact, I've had two conversations about this exact scenario already today. So I think most of you who are on this already know what a Section 106 scheme is. But if you don't, it's where a house builder has to provide a percentage of homes as affordable housing as a planning obligation. And this affordable housing is usually bought by an RP. Some Section 106 scheme contracts are what I'll call turnkey contracts. So in this context, I mean the RP pays a small deposit with the balance of the price on practical completion. And that's kind of generally lower risk for the RP. But many house builders want to improve their cash flow, and so will be looking for stage payments from the RP. And this is where the RP has really got this exposure to the contractor insolvency risk. But they're in a slightly odd position because they might not have the same availability of mitigation as other employers. For example, step-in rights may be impractical because the RP is taking such a small part of a much larger site. House builders may take the view that the risk to the RP in this scenario is minimal, but I think what you have to bear in mind is that RPs are in a special category. They operate in a robust governance framework, and they're often charities, and ultimately what they're spending is quasi-public money. So it is particularly important for RPs to know that they've considered and taken development risk into account and have taken adequate steps to protect themselves. So one of the things that RPs have used as protection is the contractor insolvency cover that you get under NHBC or any other kind of new build warranty scheme. But what we're finding increasingly is that that cover is either not available at all to certain smaller builders or is only available at a prohibitive cost. And the other limitation on that cover is that it's usually limited to about 10% of the contract price. And I'd query whether that would be enough to cover an RP's losses in all contractor insolvency situations. So increasingly, we're in a situation where we're stuck between builders who can't get insolvency cover, or if they can, the price is prohibitive, and RPs who aren't comfortable to go ahead without adequate security for their potential losses in an insolvency situation. I mean, I think on bigger sites and bigger Section 106 schemes, an RP is going to be looking at some of these general risk mitigation techniques that we're going to be talking about in this webinar. But on smaller schemes, those solutions they're going to be disproportionate or just impractical, in which case the only answer may be to de-risk the transaction and go back and insist on a turnkey contract, or at least pushing as much of a consideration as possible towards practical completion. And that was a very kind of quick overview of some of the RP issues there. And I'm now going to pass over to Jason, who's going to talk a bit more about insolvency risk mitigation.
Good afternoon, everyone. And thank you as well to Nicola, Simon, Estelle, and the House Percival marketing team. And thank you to everyone who's joined the webinar today. Like House Percival, Miller provides services, expertise, and bespoke solutions to the construction sector. We're a chartered insurance broker operating globally. We've got over 700 colleagues. And we've been operating in specialisms for 120 years, but you won't find us on the high street. We're all about leading those specialisms. Our sports specialists, for example, represent 60% of the England football squad. We represent the Premier League, much of the Premier League stadium and players. Our entertainment team will arrange the protection for many of the tours and the world's biggest bands and artists you might go and see. So as you can see, we operate in a specialist space. And of course, our construction specialisms is one of the particular areas that we have enormous offering to our clients. And Miller are one of the few specialist independent construction brokers in the UK. As the risks in our sector escalate, we continue to see organisations turn to Miller to help de-risk their businesses and their projects. And we've got a team of over 25 experts dedicated solely to construction risks and solutions. Miller are also the sole appointed risk advisory member of Build UK. And we deliver expertise, and we've got dedicated colleagues in traditional builds, lenders advisory, security, renewables, infrastructure, international projects, and we've also got colleagues dedicated to construction PI. And we represent any party to the industry as well. Of course, today we're talking mainly from the employers and developers perspective, but we can also represent contractors and financiers, for example, too. And our major focus is on providing risk advice and developing risk strategies and solutions pre-construction. And now we find that contractor insolvency is one of the biggest risks faced by any project owner and their financiers and investors during a construction project. So today we'll also be now looking at some of the circumstances and consequences faced by owners when the contractor becomes insolvent, and how with proactive approaches and solutions, owners can help to mitigate those risks from the very outset. So let's start by looking at why this change matters for owners, developers, and their financiers. Well, as Simon has outlined, construction is an incredibly high risk activity. Sadly, according to the HSE, it's got one of the highest workplace fatality rates, continues to be one of the most dangerous industries to work in the UK. And actually in 2021, it had the highest rate of insolvency of all industries in the UK. About 1 in 5 of the insolvencies was in construction. And we see that the industry is beset by those high frequency loss events, by high frequency severity losses too. And of course, when you combine a high risk profile with multi-million-pound assets, you've got that very dangerous risk cocktail. So for employers, investors and contractors, they all have to constantly navigate that risk profile and the uncertainty that it creates for their balance sheet, particularly when the risks are evolving so rapidly, as we see in the current commercial environment. When contractors fail to navigate those risks and they can't stay afloat any longer, the impact of that insolvency can be far-reaching. Now, once a contractor is declared insolvent, the project site is typically going to be vacated by that insolvent contractor. And the gates are going to be temporarily locked to everybody, including the owner of the site. It's likely that site security will have also departed, they won't have been paid, and they will be leaving a partially completed project, often a multi-million-pound asset at that point, enormously exposed to numerous perils, things like arson, theft, malicious damage, and of course to weather and storm events, particularly through the winter, spring and autumn months. So we've got this huge danger that now exists for the employer. A major site left unchecked is ultimately going to suffer potentially severe damage or could be destroyed. And worse still, we've got this other problem. When a contractor becomes insolvent, their insurance is going to typically become ineffective too. And that is going to leave the site uninsured. And all of a sudden, we've now got an owner's financier's asset at substantial risk and uninsured. And if the site does suffer damage or is destroyed, then the owner may not have the balance sheet resilience, and they could be at risk of insolvency too in that scenario. As Simon also described, we've got the well-reported domino effect of unpaid contractors, suppliers, and other unsecured creditors who are at risk of insolvency as a result of those cash flow issues. And for subcontractors, they may well have plant and equipment locked within the site compound, of course, at risk of damage too, but they will potentially still be incurring hiring fees as well, but unable to retrieve their plant. Now, whilst robust contractual step-in rights may eventually enable some continuation, some contractor appointments and works, ultimately, it's likely that a formal cessation of works will need to occur whilst the replacement contractor is tendered. The remaining project will face many changes as a result. It's likely to see a delay to practical completion. It's going to incur increased contract values. And there's also going to be a likely exclusion for defects associated with the prior works of that contractor that's gone into difficulty. And a major headache that owners are going to experience is that they'll have difficulties obtaining structural warranties, which can also then lead to future sale issues. Owners will also face delays or the complete loss of future revenue streams that they may well have relied upon and which underpins that original investment decision in that project. And furthermore, there's going to be additional costs that are likely, extra debt servicing costs, the provision of alternative accommodation, and of course for financiers too, the project failure or default potentially on the repayments of their loan. So as we can see, the implications of that contractor change and the insolvency midterm can be widespread. So let's move on now and have a look at the number of approaches that are going to help mitigate that insolvency risk. And of course, whilst contractor insolvency is always going to be enormously disruptive to any project, there are a host of pragmatic measures that can be taken at the outset that are going to substantially reduce the impact that an employer or indeed their financier may face. We've got 5 key recommendations today. The first is to seek expert risk advice at the pre-construction project stage. Now, because construction is such a high-risk industry, the engagement of risk expertise at this point is going to be cost effective. It's going to drive savings in the cost of risk, and it's crucial to identify and help drive solutions to not just insolvency exposures, but all of the other project risks that exist too. All too often, risk advice is sought too late in the process. So it's important to choose that right path from the very beginning. A bespoke risk strategy can be developed pre-construction, ideally before contracts are drafted and tendered. And that will determine how best to mitigate, manage, and transfer insolvency and other project risks. The risk and insurance section, for example, of the JCT contract can, of course, be drafted not just by the legal team, but it can be done in collaboration with risk experts. And that will help to implement the risk strategy and gain the maximum negotiating leverage in the tender process and help to extract unnecessary costs from that tender. Now, the second recommendation today is arguably one of the biggest, and it's essential to have a robust employer-led asset protection approach. In life, we all understand the importance of insuring our own assets. We insure our cars, we insure our homes, our business premises, we insure as organizations. And we wouldn't dream of asking a neighbor to insure our house for or our car. Businesses wouldn't ask the company next door to insure their premises or stock. In life, we all know and understand that as owners of assets, we arrange the protection for those assets for good reason. And actually, a construction project is no different at all. Arguably, in a high-risk scenario, there's even more importance in that, particularly when it's a multi-million-pound asset. So the message is that the contract works are best insured by the owner/employer. Why is that important, though, in the context of today? Well, critically, a robust contract works insurance taken out by the employer will continue to operate even if the contractor changes due to insolvency mid-term. It means that the owner is not going to be left with an uninsured asset. They won't have to pay twice for cover through two different contractors. They'll have the full oversight and control of their cover. And of course, as the policy holder, they'll have direct engagement with the insurer. It also means they can allow the policy to evolve as the changing project characteristics occur, such as the scope of works, the timelines, and the values. And naturally, for financiers, it gives them peace of mind that their investment has the optimum protection. So there are two top tips here. And the first is to avoid the false economies of contractor policies. Of course, for many employers, we still see them being chosen because they seem convenient. But ultimately, in the context of today, they are going to leave the employer most exposed to insolvency risk and a host of other potential problems. And so we strongly always advise to avoid utilising contractors' insurances. And the second top tip on this recommendation is to be aware of off-the-shelf rigid policies that get issued by insurers and may continue to leave owners exposed. I tend to call it a square peg, round hole type scenario, but ultimately the message is every project is unique. So it's important to make sure that your risk advisor is a construction expert and that the policy that they provide is written by the broker, not the insurer, and that it's written uniquely for the needs of the project. Moving on then to our third recommendation, it's ultimately to consider protection for latent structural defects post-completion. As we know, defects liability typically lasts for 6 or 12 years. But what happens when the contractor is insolvent and they're no longer able to discharge their post-completion liabilities? Well, it has actually always been a risk for owners and developers. But given the changes in the industry now, it's a major possibility of, that employers may find themselves suffering with that contractor insolvency. And addressing structural defects that emerge post-completion will always be a substantial challenge. But ultimately, latent defects insurance is becoming increasingly popular with property owners and developers, and it's going to indemnify that building owner for damage to the structure or the building envelope arising from construction defects. Our tip here is during that pre-construction stage, that is the time to secure the latent defects cover. It will be most cost effective at that point before the contract has got underway. And what we will do today, given the complexities of latent defects cover, you'll see that there is in the slide a QR code that will allow you to scan that code and access more information about latent defects insurance after today's presentation. So moving on to the fourth recommendation, and that is to implement resilient due diligence and risk governance regime. Estelle very kindly touched upon some of the critical importance of due diligence in the process of mitigating risk. And of course, there are significant risks, for example, within the supply chain. Failure to manage and check those risks can leave the owner highly exposed to the insolvency position of either the contractors or indeed the subcontractors. When consulting with clients on risk, we often find that the validity of contractors' cover remains unchecked at each renewal. Contractors, we know, pass their risk down the contract chain, but we often find that the subcontractors' insurances are not being assessed. We rarely see any checks being made on the efficacy of contractors and subcontractors' insurances in order to respond if the employer did need to claim against them. I'll give you some examples. We regularly see roofers with working at height exclusions or hot works exclusions they didn't know about. We'll see fountain specialists with exclusions for working adjacent to water. We'll see working at depth exclusions for trades who are doing basement works. And of course, we come to PI, professional indemnity policies. We see that they may have already been eroded by existing claims or notifications. And of course, more recently, we're seeing substantial restrictions in fire safety cover in that sector. So simply through a resilient due diligence and risk governance regime on a project, you can help ensure that the insurances provided for by that project will operate when you need to rely on them most in order to respond to an incident. So we move on to the last of our 5 recommendations, and that is to secure robust contractor performance bonds where possible. And at this point, it gives me great pleasure to introduce to you Callum, who's one of our experts in surety at Miller. And Callum's going to explain more about the value of bonds in order to protect against that insolvency risk. Thank you.
Thanks very much, Jason. There's some really good insights there, so thanks for that. So first and foremost, I'm going to talk briefly about what a performance bond is, and I thought best is to provide a brief description for anybody who is unfamiliar with them. So a performance bond is a financial instrument issued to one party of a contract, the beneficiary, as a guarantee against the failure of another party, the principal, and in this case, usually the contractor, in the satisfactory completion of a project under a contract. Performance bonds can either be issued by a bank as a bank guarantee or via an insurance company in the form of a surety bond. Typically, the value of a performance bond is 10% of the underlying contract, and the compensation allows the beneficiary of the bond to overcome difficulties that have been caused by non-performance of that contractor, such as finding a new contractor to complete the works, for example. So moving on to the next slide, we'll be looking at parental company guarantees versus performance bonds. So more than ever, given the current climate, it is of grave importance for employers entering into construction contracts to protect themselves from contractor default, especially in relation to contractor insolvency. Consideration should be given to requesting a contractor provide either a parent company guarantee, a performance bond, or both. In this slide, we'll explore the characteristics of both a parent company guarantee and a performance bond. Firstly, the outcome of making a call under each product may vary. This does depend, of course, on the drafting, but a parental company guarantee usually has a distinct focus on providing a performance solution. That in the event of default by the contractor or insolvency, the parent company will step in and focus on completion of the project. For the sole purpose of the completion of the project, a parent company guarantee is a viable solution in mitigating the risk of a contractor insolvency. Until, however, the point is reached in which the insolvency event was to affect the entire group, or at least up until the level that the guarantee is being provided from. In this instance, the parent company guarantee would be rendered worthless and could leave the employer in a vulnerable position with an incomplete project and no means of remedy. However, this is where the more distinct benefit of a performance bond provided by a surety is realized. Considering performance bonds are provided by an independent third party, being either a bank or insurance company, the employer then benefits from the security of a guarantee that is provided by a financial institution with a solid credit rating, therefore mitigating the overarching risk of a group insolvency event. As we can see, performance bonds provide an additional level of comfort over the PCG. However, there are some points to consider. A performance bond liability, as we mentioned earlier, is usually capped at 10% of the contract value, whereas a parent company guarantee can be uncapped and sometimes enforceable for up to 12 years. Again, this is subject to its drafting. A rather obvious point, but still worth mentioning, a parent company guarantee can only be provided if there is in fact a parent company. Should the contractor be a single entity and the parent company guarantee is not available, and therefore an unviable solution. Finally, an important point to note is the fact that sureties undergo a rigorous underwriting process in order to provide capacity to the contractor. Should a bond be available from a contractor, a level of comfort should be had by the employer in that the surety is confident in the contractor's ability to deliver their obligations under said contract, and this could be considered as a credit enhancement for the contractor. It would be prudent to request both a PCG and performance bond at tender stage, and following adequate internal due diligence by the employer, an informed commercial decision can then be made as to which form of security would best suit the requirement, and if so, maybe both. So moving on to the next slide, I'm going to talk a little bit about the ABI formal wording and its effectiveness in an insolvency event. So in doing so, I thought best to provide a quick overview of what the ABI wording is. The ABI model form of guarantee bond was published on the 22nd of September 1995, with the intention to form an industry standard form of wording, which would be, among other things, in short form, in clear modelling language, operates as a guarantee of payment on contractor default and not merely on demand, provides the employer with an entitlement to damages immediately at the point where the contracting party becomes liable to pay damages under the contract, minimises the risk of litigation, and contains a clear expiry. So a contractor insolvency event is a decisive test for effectiveness of the performance security package implemented at negotiations with a contractor. As we have already established, the more robust option in such an event is a performance bond granted by a financially stable provider. As part of these negotiations, the bond wording will often come into dispute, quite rightly, considering in the insolvency event, the bond wording is what ultimately defines the employer's right of subrogation. This being the case, and coupled with the increased rates of contractor insolvency, there has been a refined focus on the ABI formal wording and its effectiveness within an insolvency event. The default position when requesting bonds should always be to utilize the ABI formal wording, mainly due to this formal wording being unanimously accepted throughout the surety market, as well as its conditional nature. So under the ABI, the surety's obligation are noted as follows: satisfy and discharge the damages sustained by the employer as established and ascertained pursuant to and in accordance with the provisions of or by reference to the contract, and taking into account all sums due or to become due to the contractor. An important point to note is that under most standard construction contracts, the original contractor becoming insolvent wouldn't constitute a breach of contract. This being the case, we often see forms of the ABI wording being requested which include an insolvency clause, an example of which I've added on the slide. Inclusion of such a clause then renders the bond on demand, which is obligation to a surety that they don't always accept and will often require a higher premium rate. However, under some standard building contracts, an insolvency event enables the employer to terminate the contractor's employment. This does not mean that the contract itself has come to an end, but merely the contractor is no longer obliged or entitled to continue the works. The employer can then obtain possession of the site and engage a replacement contractor to complete the works. In this case, termination of the contractor on said contract does then constitute a breach under the contract in the failings of their obligations. The employer in this situation is then entitled immediately, when such determination occurs, to suspend all payments to the contractor, and thereafter to recover all direct losses and expenses, which is caused by the reason of the automatic detrimentation of the contract's employment on insolvency. For reference, I've included 2 case law studies which highlight the points discussed and demonstrate that the ABI in said situations was fit for purpose in an insolvency event, and the need for specific insolvency language unnecessary. So moving on to the next slide, we're just going to talk through the key considerations and takeaways. A parent company guarantee provides minimal comfort in the event of a group insolvency event. The ABI formal wording can be considered in the mitigation of contractor insolvency. It is not uncommon for the employers to request parent company guarantees and performance bonds at tender stage. An important mitigation factor can be the employer conducting thorough financial due diligence on the contractors. So thank you all for your time today. I hope you found benefit in our content, and I'll hand back to the House Percival team, who will go through any questions that we might have had.
Great, thank you. Thank you, Callum. That's very interesting and timely. We've had a couple of questions in, but obviously if you have any more, please feel free to stick them in the Q&A and we'll get through as many as we can. So I think the first one, picking up on, actually Callum, probably on for you, picking up on that last point, I had one in saying, considering the increased level of contractor insolvencies, has this affected the level of capacity available in the surety market at all?
Well, that's a really good question. And considering the increase in insolvency, you might expect that underwriters become more nervous in writing capacity in the contractor space for surety bonds. However, that's not the case. Every underwriter and market I'm speaking to at the moment are very, very keen to provide capacity for that area and the construction sector. One point that I would mention is the fact that the underwriters are looking at contracts in a far more granular detail. So they're looking at the financials through a microscope, should we say, and I would just expect the fact that this process can take a little bit longer, and the contractors would have to provide a far greater level of detail when looking at providing bonds in favour of beneficiaries. So that would be it definitely is open for business. It's just can take a little bit longer, and the information a little bit more lengthy.
Great, lovely. Thank you for that, Callum. Next one, I'm conscious of the time, so I'll try and do the ones that hopefully look like they're relatively easy to answer. But we had a question: is what level of cover should employers generally be looking for in contractor insolvency risk policies? I'm presuming that will be yourself, Jason.
Yeah, I'll pick that one up, Simon. That's great, thank you. It's obviously quite a broad question. So the nature of coverage for insolvency risk comes down to the characteristics of the risk profile of each individual project. First of all, we would look at ultimately the assets that need to be protected. It's always the first place to start. And as we alluded to in the presentation, if they are the employer's assets, then we would first of all want to make sure that they are covered up to the full reinstatement value. And in the current environment, that reinstatement value is critical because it should include sufficient leeway for inflationary costs, the additional labour costs that may be incurred following a major incident. So we would look at the type of works, the materials. For example, if it's got a high timber usage, we know that the costs of timber have escalated substantially. So sometimes it can come down to the nature of the works and the materials used. When it comes to latent defects, again, it's critical to look at the minimum sort of obligations from a defect liability perspective, but then also to make sure that it is a robust program that's going to respond and not be voided following any insolvency events. Ultimately, it's critical to make sure that the asset is fully protected on behalf of the employer.
Lovely, thank you, Jason. That's very helpful, very comprehensive. And I think probably time for one more. Possibly this is one for Estelle, I would have thought. So this was: with a lack of appetite or availability for insolvency cover under LDI, are RPs open to contractor insolvency bonds as an alternative?
Interesting one. And yeah, I think they definitely would be if the cover is adequate. I think perhaps the problem with that as an alternative solution is going to come down to cost, and at what cost are those bonds going to be available, and whether that would actually be any more attractive than buying the add-on LDI warranty cover. But yeah, I think it is definitely something that should be explored if there is a problem with getting the risk mitigation otherwise.
I'm sorry, I realised I'd muted myself there. Sorry, I think given that we're literally coming up 3 o'clock now, I think we will probably call it there. Obviously, if any other questions that arise afterwards, then I think we'll put in contact details, and please obviously feel free to contact us if any of us can assist with this or anything related to this. But otherwise, I suppose it's just up to us to say thank you very much for your time this afternoon. We appreciate it's a hot day. So I hope you're all sitting in a nice air-conditioned office somewhere. If not, get into an air-conditioned office now and cool down. And thank you very much for your time and attendance this afternoon.
Thank you.